The silver market episode unfolded as a sharp and revealing moment that exposed how sentiment, narrative, and positioning interact at key price levels. The trigger was a bullish research report from Bank of America projecting silver prices as high as $309 an ounce by 2026. The forecast immediately altered market psychology. For many participants, the involvement of a major financial institution transformed a long-term projection into a perceived near-term signal. Retail buying accelerated rapidly, driven less by immediate changes in supply or demand and more by the authority attached to the source of the report. This surge in enthusiasm pushed silver prices toward the $83 level, an area where the rally appeared to stall almost as soon as it reached it. What initially looked like confirmation of a breakout quickly revealed a different structure. The price advance lost momentum, and instead of continuing higher, silver reversed sharply. The timing of the reversal, occurring directly after the release and dissemination of the bullish headline, framed the move as a textbook sell the news event. The report did not initiate a sustained upward trend. It marked the point where upside pressure was exhausted. In this context, the Bank of America forecast functioned less as forward-looking guidance and more as a catalyst that concentrated buying interest into a narrow window. That concentration mattered. Markets require liquidity for large positions to change hands, and the sudden influx of retail buyers provided exactly that, as demand surged on the back of the headline. It created the conditions necessary for larger players to reduce exposure without immediately collapsing price. The abrupt reversal that followed underscored how fragile the rally had been. Once the wave of headline-driven buying subsided, selling pressure became dominant. Prices fell quickly, erasing gains and forcing late entrants to confront losses almost immediately. The speed of the move revealed that the advance had not been supported by broad-based accumulation but by short-term enthusiasm tied to a single narrative event. Rather than signaling a failure of the long-term silver thesis, the episode highlighted how markets often use bullish news at critical levels to facilitate redistribution. The event near $83 stands as a clear example of how authoritative forecasts can coincide with market tops, not because the forecast is false in the long run, but because of how and when it is introduced into an already extended market. The mechanics behind the move become clearer when examined through the lens of liquidity rather than prediction. Large institutions cannot exit meaningful positions quietly when markets are thin. They require active participation on the other side of the trade. Bullish headlines serve that function by drawing in buyers who are motivated by expectation rather than positioning. In this case, the Bank of America report acted as a focal point, pulling attention and capital into the silver market at precisely the moment when supply was waiting. Retail participants responded to the headline with urgency. The projection of $309 silver reframed risk perception, making prices near $83 appear justified or even conservative. This reaction was not driven by short-term fundamentals but by narrative authority. The more buying accelerated, the more liquidity became available. Each market order to buy allowed a corresponding sell order to be absorbed without immediate price collapse. This is the essence of a liquidity trap. Demand is real, but it is being used, not rewarded. Institutional sellers do not require prices to fall in order to profit from distribution. They require prices to hold long enough for volume to transact. The bullish narrative created that holding period. As retail demand flowed in, it masked the presence of aggressive sellers. To outside observers, the market appeared strong, even resilient, as price hovered near highs despite heavy activity. In reality, this stability was artificial, maintained by a constant exchange between incoming buyers and exiting sellers. Once the selling objective was largely achieved, the structure changed. There was no longer a need to support price. Without continued headline-driven demand, the market was left exposed. Liquidity that had been abundant moments earlier evaporated quickly. The same participants who rushed in on bullish expectations now faced an environment where bids were thinner and confidence was weaker. The transition from accumulation illusion to distribution reality happened rapidly. This dynamic explains why the reversal felt sudden rather than gradual. The buying pressure had a single source and a single trigger. When that trigger lost relevance, the imbalance became visible. The liquidity trap did not fail. It completed its function. Retail demand fulfilled its role as exit liquidity, and once that role was exhausted, price adjusted to reflect the absence of support. The result was not an accident or anomaly, but a predictable outcome of how narrative-driven liquidity operates at critical levels. The shift from buying pressure to selling dominance unfolded with little delay once the liquidity balance changed. During the initial surge, price action appeared orderly, even controlled, as silver traded near its highs. Beneath that surface, however, sell orders were steadily absorbing demand when the flow of new buyers slowed. There was no longer sufficient pressure to counteract that supply. The market tone changed almost immediately, moving from stability to vulnerability. As prices began to slip, the reaction intensified. Short-term participants who entered on the bullish headline were suddenly positioned against momentum. Their exits added to selling pressure, accelerating the decline. What had seemed like a minor pullback quickly developed into a sharp move lower. This was not the result of a single large seller, but of a cascading response as confidence eroded and positions were unwound. The speed of the drop highlighted the imbalance created during the rally, because the advance was driven by concentrated enthusiasm rather than broad accumulation. There was little structural support once sentiment shifted. Price did not drift lower. It fell decisively. This behavior reinforced the interpretation that the rally had been distributive, not constructive. The market had moved higher to facilitate selling, not to establish a new base. The decline also exposed how quickly narrative-driven conviction can reverse. Participants who bought on the authority of a bullish forecast were forced to reassess their assumptions in real time. The same headline that attracted buyers lost its influence as price contradicted expectation in the absence of fresh catalysts. The market responded to order flow rather than optimism. This phase of the move was marked by compression rather than debate. There was little ambiguity about direction once selling took control. The price action conveyed a clear message. The buying wave had been absorbed, and the market was resetting. The rapid transition from euphoria to decline illustrated how quickly conditions can change. When liquidity dries up, leaving price to adjust to a more balanced and often lower level. The technical structure of the silver chart provided a clear visual record of what had taken place. As prices approached the $83 level, upward progress repeatedly stalled. Each attempt to move higher was met with immediate resistance, signaling the presence of aggressive sellers willing to defend that area. This behavior formed a classic double top, a pattern that emerges when buyers are unable to push through a known ceiling despite multiple efforts. The significance of the double top lies not in its appearance alone, but in its timing and location. It developed precisely where the surge in bullish sentiment was strongest, following the dissemination of the Bank of America report. Rather than confirming a breakout, the pattern showed that demand was being absorbed. The market was not lacking buyers. It was encountering supply that was equal to or greater than that demand. This imbalance prevented continuation and marked a shift in control from buyers to sellers. In technical terms, a double top is often interpreted as a bearish reversal signal because it reflects exhaustion. The first peak attracts attention and confidence. The second peak tests that confidence. When the second attempt fails, it confirms that resistance is not accidental but structural. In this case, the repeated failure near $83 suggested that sellers were positioned deliberately at that level, using strength as an opportunity rather than a threat. The pattern also aligned with the broader narrative of distribution. Price was allowed to rise into resistance, but not through it. Volume increased without corresponding progress, a sign that transactions were occurring without net upward movement. This condition typically precedes a directional move lower, as the imbalance between supply and demand resolves itself through price. What made the double top especially important was its clarity. There was little ambiguity in how the market responded at $83. The rejection was decisive, and the subsequent decline confirmed that the pattern was not noise. It served as technical confirmation of the liquidity dynamics already at work beneath the surface. Rather than functioning as an isolated chart signal, the double top reinforced the interpretation of the event as a sell the news episode. It translated narrative and order flow into visible structure, showing how bullish expectations collided with institutional selling. The chart did not predict the reversal in advance. It documented it in real time, capturing the moment when momentum failed and control shifted.